I think that Warren Buffett is, first off, unfairly characterized as a value investor. Yes, he's the one that has preached forever, buy stocks below their intrinsic value. However, if you look at what stocks has Warren Buffett made the most money from, do you know which one it is?
Is it Apple?
It's Apple. He made more money from Apple than like every other, I think almost every other stock that he's owned combined. It's been an unbelievable investing. And yes, it was a value investment at the time. But my favorite thing about Warren Buffett is his mentor, the person he learned everything about valuation from, was Ben Graham. Ben Graham was like the classic. He discovered what a business is worth and always pay less than that. Yet even Ben Graham's portfolio, the only reason his portfolio did so well is because he broke his rule. He put 25% of his portfolio, I think it was 25%, into a growth stock. And that growth stock was Geico. And that one stock went on to deliver an unbelievable return for investors. And when I look back at like Warren Buffett's portfolio, the best investments he's ever made, See's Candy, Coca-Cola, Apple. What the most important decision that Warren Buffett made was not paying 5 times earnings or 8 times earnings or 15 times earnings. The most important decision he made was to buy and hold great companies, period. And if you go back to when he bought Coca-Cola in 1988 or something like that, even if he paid a 52-week high or an all-time high for Coca-Cola, it would still have been a phenomenal investment at that time. So that just shows me, even when studying someone like Warren Buffett, who I think is mischaracterized sometimes, it's like buying great companies and holding them is infinitely more important than paying the perfect valuation for those companies. So that general style informs what I do today. I like to think in terms of odds, quality, and potential. In general, the higher quality the company and the higher the long-term potential is, the less valuation sensitive I am. If I find a billion-dollar company that I think could legitimately be worth $20 billion someday, I'll buy it. Period. I don't care what the price to sales ratio is. I don't care what the price to earnings ratio is. I'm buying it. The returns are if I think the return is 20x, I'll pay almost any valuation. Conversely, if I find a company that's worth $200 billion and I say, well, this could be a $400 or $500 billion company, that's a 2x return. In that case, I'm going to be much more price sensitive and I will pay much more attention to the valuation. Overall, the higher the potential, the less valuation sensitive I am. The lower the potential, the more valuation sensitive I am.